Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Corsair stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Corsair designs and sells a range of products for computers, including high-speed DRAM modules, ATX power supplies, USB flash drives, computer cases, speakers, gaming chairs, also gaming peripherals such as keyboards, microphones, headsets, and computer mice. Its products are mainly purchased by gamers, streamers, and content creators. It sells hardware and software, although software tends to have higher margins than hardware. The company is headquartered in Fremont, California, and was founded in 1994. It started trading in 2020 and can be found on the Nasdaq, Mexican Bolsa, Deutsche Börse, London, and Munich Stock Exchange. The company is number one in its category, selling products to 75 countries with over 18% of the peripheral gaming market and 42% of the PC market. It sells products directly to the end user, like me and you. They also sell through retailers such as Amazon and Best Buy. Amazon makes up 25% of the company's revenue. They also have a large distribution network as well. The company mentions they are growing their direct-to-consumer segment, which is good for investors since direct-to-consumer has higher margins, as it cuts out the middleman. The market is really big for this company since there are 2.6 billion gamers, 12 billion streaming hours per year, and esports revenue of about $1 billion. The company is really focused on the committed gamer who is likely to spend hundreds or even thousands of dollars on this company's products. It has some of the best products in the industry. They have a great reputation and a strong customer loyalty. It has won 4,000 awards in 45 countries. Some really well-known influencers and gamers use their products, which will give them more exposure and credibility. It ranks in the top 4 in different products. It is number 1 in memory, cases, power supply units, and cooling solutions. Let's get started with the model. This is a mid-cap company, 2.7 billion market cap. They're trading at $28 a share, and they have 94 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they had negative free cash flow in 2018, and that's grown a lot to $181 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative in 2018 and 19, but positive in 2020 and growing even more in the trailing 12 months. Revenue is the sales for the company, and that more than doubles from $900 million to $1.9 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Cost of labor and cost of materials is a big cost of revenue for this company. Revenue minus cost of revenue gives you your gross profit, and that almost tripled from 2018 to the trailing 12 months. Below that is operating expenses. Marketing and research and development are big operating expenses for this company. Then below that is operating income, which nearly 10x from 2018 to the trailing 12 months. So they are growing at a really rapid pace. Below that is the interest they pay in their debt, and that was the lowest amount they paid in the past 12 months since 2018. And then the bottom line of the income statement is their net income, which is positive in 2020 and the trailing 12 months. So their income statement looks really good. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So even though they had negative net income in 2018 and 19, they still generate a positive cash flow. Because when you look at the income statement, there's a lot of non-cash items on there, like depreciation, that bring down your net income. So it is possible that you have no net income and you pay no taxes, and you could generate millions of dollars in cash flow. So non-cash items are good for companies because they bring down their net income and they save in taxes. The only negative about having a lot of non-cash items is because it makes your net income look a lot lower, so some investors may not buy the stock thinking the company is struggling. And then you have capital expenditures. So since they do manufacture products, they will always probably have some CapEx, and this should grow over time as they expand their business. Operating cash flow minus CapEx gives you your free cash flow. and they do have positive free cash flow every year except 2018. They added over $100 million of debt in 2018 and 2019, but they're paying down a lot of debt in 2020 and even more in the trailing 12 months. They IPO'd in the second half of last year, so this $119 million must be from the IPO. This is the equity section of their balance sheet, and they have about $500 million of equity. They generated $440 million from selling stock. Every time a company sells common or preferred stock, they attach a par value to the stock. It's usually really low, like a penny. That's just a way for them to keep track of the number of shares in the market. So the sum of all the par values is their capital stock. And then the difference between how much money they received from selling stock and this $9,000 is additional paid-in capital. And the retained earnings is their historical profit or loss. Historically, they've profited $44 million. We've looked at a lot of companies on this channel, and so many of them have negative retained earnings. And there are some companies that don't even have any revenue, like a healthcare company that needs to create vaccines or medications. So they're constantly spending money trying to get approval, so they're always going to have negative profit until their medication gets approved by the FDA and they could start selling it. But this company already has positive profits. You may be wondering, why did they go public? Why couldn't they stay private since they're profitable? Because when you go public, you have to hire an accountant or an accounting team to do your 10K, your 10Q, and all your financial reporting. Plus you have to hire someone for investor relations because you're going to always have investors calling, asking questions. Plus you're under a microscope. People are looking at your numbers a lot closer because there's a lot of investors out there who want the information. And you have to pay fees to go public. So why do you go through all that trouble if you're profitable? Just stay private. Plus, if you own a majority of the company, like 50% or 70% of the company, you might have to give up most of that ownership when you go public. Well, the two big benefits of going public are you get to monetize the business. So if you do own 50%, you might get a nice payday of a few $100 million or even billions of dollars when you go public. Because it is hard to find investors. If you own a company and it's not a public company and you need money, you either have to go to the bank or you have to find an investor out there who's willing to buy part of your company. That's not always so easy. But if you're public, then you could just issue more shares out to your investors and get more money. It's a lot easier to get funding. And if you want to grow and scale, you might need to go public because you need the money to grow and get bigger. And it's hard to do it when you're private. So there's a lot of pros and cons to both of them, depending on your long-term plan for your business. Let's look at the capital structure. $488 million of equity, $300 million of debt. They're 62% equity, 38% debt. And their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 9.3%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year for, that's $4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.5 billion. We divide that by 94 million shares. And we get a calculated stock price of $38. They're trading at $28, so they're trading at a 25% discount. It's a buy according to the model. So the way I calculated their future free cash flows, I think it was pretty modest. I grew at 10% a year until 2024, then grew at 2.5% in perpetuity. I do feel the company can easily beat my projections, and I'm still coming out with a stock price a lot higher than they're trading at. Simply Wall Street values the company at $76, so they're saying they're really undervalued. It seems like Simply Wall Street values companies really high. It's a lot safer to say a company's undervalued than overvalued, because if you say a company's overvalued and their stock goes down, then there's some liability there. They may say you're the reason our stock went down and you may get sued. I know that's unlikely. It's so much safer to say a stock is undervalued. Also, I've noticed when I say a stock is overvalued, I get a lot of negative comments. Whatever my result is, it is, and I'm not going to change that because I'm concerned I may bother people or hurt their feelings. Because sometimes people cannot hear the truth. They get so married to a stock, and anytime they hear something negative, they automatically dismiss it. So don't be that way. Don't dismiss other people unless you did thorough research and you know they're incorrect. Don't just say you're incorrect because it differs with my views. 4 analysts priced this stock and the average price target was $39. So the stock IPO'd almost a year ago and it's up almost 100% since it IPO'd. It did break through $50 at one point. It is fairly common when a stock IPOs, it gets pushed up really high and then there's a big sell-off. The stock is trading above its IPO price. Sometimes a stock drops a lot at IPO and takes a couple years to get back up there. I could see this stock coming down to $20 a share, and I don't have much proof why. I'm just basing that off of market dynamics and what I've seen in other stocks. But I think $20 is a good entry point. The stock has gone up 92% since it IPO'd, while the S&P 500 went up 31%. The low was $14, the high was $51. And the stock is trading below its 50-day and 200-day moving average. About 3 million shares are traded each day on this stock. Of the 94 million shares outstanding, only 35 million are on float. 68% are held by institutions. The short sellers are out in droves on this stock. Over 20% of the shares on float are shorted. And analysts are pretty bullish on this stock, projecting their earnings to grow a lot more than its industry and their revenue to grow a lot more than its industry. In the past 5 years, their annual earnings increased 69%. In the past year, it increased 400%. If you invested $10,000 into this company when it IPO'd, you would have been at $35,000 after a few months. But if you're still holding, you'd be at $19,000. That's still a really great return, nearly 100%. The reason it has a low float is because Eagle Tree Capital owns 59% of the stock. So their stock is locked up. No one can buy it. They can sell it if they want, but it's not available for the public to buy. BlackRock owns 3%. The founder and CEO, Andrew Paul, owns 2.8%, then Vanguard, then Susquehanna. Let's look at their financial ratios. They have pretty good price multiples. Their PE is about 18, and they're a growth company. They're growing a lot. So when a company is in growth mode, they tend to have really high PE ratios, and investors are still willing to pay for a stock with a high PE because they're expecting their revenue to grow a lot in the future. But this company is growing a lot, and it has a pretty good PE ratio. They have a really good price to sales ratio, much better than the market median average, and their price to book is between the market median and average. But most of their equity is intangible assets. They have over $560 million of intangible assets. So their tangible book value is negative. They have a really good return on invested capital of close to 27%. They can cover their interest payments almost 7 times, a really high ROE of 31%, and they have a good current ratio of 1.4. Their quick ratio is below 1. Even though it says 1, it's rounded up, because their current liabilities, as you can see, are higher than their current assets minus inventory. And they have $120 million of cash on their balance sheet, $300 million of receivables, and $230 million of inventory. They seem to be fairly well capitalized. They generated $181 million of free cash flow in the trailing 12 months and have over $200 million of working capital. So it does appear they have enough excess funding to run their operations without adding more debt or issuing more stock. Unless, of course, they want to grow their business or acquire another company, then they may need to add debt or stock. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 6 other companies in the same industry as Corsair. And if CRSR has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're a little worse in PE ratio, a lot better in price to sales. They're worse in price to book. Current ratio is fine. They're doing really well in ROE, one of the best on this list. They're a little higher in debt than the average company. And they're a lot smaller than average. A bunch of these companies are in the 20 billion market cap range. But this is the computer hardware industry. None of these companies do what Corsair does. Corsair is really in a niche market, because a lot of people use computers. They're really focused on gamers and streamers. It is hard to compare ratios. I know a lot of people do it because they understand how to do it. But even 2 companies that you think are identical, Coke and Pepsi, they're so different if you look at the assets and the companies they own. So even comparing the ratios for those 2 companies doesn't make sense. So you have to kind of compare ratios on its own. And if you want to use comparisons with other companies, just always keep that in the back of your mind. It may not be the best comparison. So to summarize, I have them trading at a 25% discount. This does seem like a good long-term stock to hold. It's really hard to know in the short term. Anything can happen in 1 year or 2 years. But if you look at a company over 10 or 20 years, the companies that are profitable and make good products, their stock goes up. And the companies that aren't profitable and don't make such great products, their stock goes down. But as you know, anything can happen in a short time frame. You can have terrible companies like AMC that go way up, and you can have really great companies where their stock goes way down. But I do think this stock will come down a little more. But like I've always said, if you're really bullish, just buy it and hold long term. Don't try to time the market. I rank their free cash flow 6 out of 10, their revenue 8 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.